And welcome to Business Incorporated live on Channels Television, where we'll be tracking the markets, of course, the economy, and we'll see how that affects your pockets. And here are the stories that matter to you. U.S. drops bond requirement for World Cup ticket holders. And East Africa's richest man plans $50 million soft drinks plant in Kenya. And new undersea cable project launched to boost Europe-Africa connectivity. And great to have you join us for this half hour. I'm Will Libong, and as always, let's get a check on the commodities space and begin with the oil markets, where we see prices were mixed on Thursday after the International Energy Agency flagged greater impending volatility, while OPEC lowered its demand outlook for the year. We see a natural gas, however, that was up 0.24% and now priced at $2.87. And now we also see Brent crude, however, up 0.3%. A lot of uncertainty in that. We see $105.95 a barrel. WTI is in the red, down 0.08%, and we see it at $100.94. Still holding on to the $100 level there. We'll see how that pans out, especially after this U.S. Trump and China's Xi Jinping meeting. Now let's see the metal space now, see how that performing. We see metals, spot gold is down. All metals are in the red today, 0.04% for spot gold. Silver is also down. Platinum, palladium, and copper, they're also down. But let's look at other commodities. Food, which really matters to us, what we put in our bellies. Meat pie prices are rising sharply despite cheap flour, raising questions about what's really driving costs. Dropped by about 14% now, yet meat pie prices seem to have jumped by about 40% in the same period. What's driving the increase despite cheaper inputs?
Okay, so it's true that wheat flour prices have actually dropped from about 64,000 last year to about 54,000 now. But the prices of meat pie has gone from about 1,000 to 1,400. So I can understand the confusion as to why these prices are not going in the same direction. But it's important to note that there are more factors and inputs that go into the making and the pricing of meat pie. Okay, so for me, a very important one is the energy prices. Okay, energy prices, as we all know, have gone up. Okay, and this has fed into the price of local diesel prices, which is a very important input for bakeries. We see that transportation costs and logistic costs have gone up due to the increase in diesel prices. Diesel has moved from about 975 to, I think, over 1,800 now. Okay, that's about a 90% increase, and this has fed into transportation costs and even operation costs. Many bakeries use equipment and machines that require power. Okay, when we look at the power situation of Nigeria, is not very stable, which has prompted many bakeries to opt for diesel generators. And as we said earlier, the prices of diesel has gone really high. So when we factor all these costs together, okay, producers have actually, because of this increase in operation and logistic costs, producers have actually passed down these price to consumers. Okay, so hence the 40% increase in meat pie prices.
Okay, let's talk about the complementary foods now. We know that meat pies, they're often bought alongside drinks. People don't just eat them like that, or other snacks. Now, if the beverage and these complementary food prices rise significantly, what does this mean for the demand for meat pies?
Okay, if we need to first understand why is meat pie consumed with these things, and it's basically because meat pie induces thirst. Okay, and so you are eating something that induces thirst. You want to take something with it. If the prices of these things go up, there's a possibility that it's not necessary that the demand for meat pie will go down. There are cheaper alternatives to these, like water. People may go to water, as we said, it's the thirst. But more importantly, when we're talking about the demand for meat pie, we need to look at some other things. Like, Nigerians are becoming more conscious of their health. Okay, so people are cutting down on their consumption of things like junk food. Okay, if more and more Nigerians continue becoming aware and conscious of their health, there actually may be a decline in the demand for meat pie. Okay. Another very important thing to note when we are talking about the demand for meat pie is the input cost. Let's say wheat flour prices continue to go down, and the energy crisis, let's say, stabilizes, and then the price of diesel kind of goes down, we may see that there may be an increase in the demand of meat pie as this reduction in prices may be passed down from the producers to the consumers.
Definitely. With growing awareness around healthy eating, I'm sure Nigerians are going to be shifting their lifestyles and looking at what's healthy for them, especially looking at their pocket as well, because that matters a lot. Thank you so much, Duluwamu Adeito, analyst with FDC, for sharing your thoughts on Business Incorporated.
Thanks for having me.
And thinking about soft drinks, still, we see Tanzanian billionaire Mohamed Dewji is set to invest about $50 million in a new soft drinks manufacturing plant in Kenya, marking Metals Group's first major entry into the Kenyan market. The facility, to be located in Mombasa, will produce brands including Mo Cola and Mo Extra, increasing competition in the East African beverages market. Construction of the multi-billion shilling plant is expected to begin within the next year as the group expands across key African markets. Now, the United States has suspended a visa bond requirement for select World Cup ticket holders ahead of the 2026 tournament. On the policy, eligible visitors who hold valid match tickets are registered under the FIFA Pass system will no longer be required to pay bonds that previously reached up to $15,000. The move comes as the U.S. prepares to co-host the World Cup with Canada and Mexico, with millions of international fans expected to travel for the tournament. Now, a new subsea cable project known as Via Africa has been launched to strengthen digital connectivity between Europe and Africa along the Atlantic coast. The project will connect the UK, France, and Portugal to several African countries, including Nigeria, Senegal, Cote d'Ivoire, and South Africa. The project is expected to support growing demand for cloud computing, artificial intelligence, and other digital services, while also improving network reliability. The initiative forms part of broader efforts to expand Africa's digital infrastructure and strengthen international connectivity routes. Now, what do we have to discuss now? Looking at the markets right now, we see trading in Africa as the NGX is marginally up today at intraday, sustaining bullish sentiments from yesterday's close, still marginal, but 0.07% at intraday. That's what we've seen, 252,689 points. And in South Africa, massive jump from them. We see 0.7% up at intraday, 118,253. A lot of bullish sentiments pouring into that index. Now, let's look at EGX. That was a lone loser today. Down today, more than 1%, 1.38%, now at 53,211,000 points now. We see the NSE, that's in Kenya, closing Wednesday's session in the red, 207 points. Now we turn to Nigeria's latest 600 billion bond auction from the Debt Management Office as a DMO, and that's scheduled for next week, Monday. What it signals for borrowing trends and investor appetite in the domestic market here in Nigeria. We have Caleb Alimi, Chief Dealer, Providence Bank, joining us to discuss this. Caleb, good afternoon. It's good to have you join us.
Well, thank you for having me.
Caleb, what are your expectations for this bond auction?
Thank you. What we've noticed from the DMO is their appetite to continue to borrow on the cheap, and we think we'll see that continue at this bond auction. We've seen the volumes they've offered from the beginning of the year up until this point, it looks like it's continued to decline, and the appetite for expensive funds have also continued to decline. So we think that they'll be able to raise, part of, not all of the funds they have on offer. They have 600 billion on offer in total in the 10-year and the 20-year papers, 2035 and 2037. But we do not think they may be able to clear it all if they still want to keep rates low. Should rates stay, below 17%, then we may not see them sell up the entire 600 billion. But if they're willing to take rates above 17%, then we could see, a significant sell-on their side. The investors are demanding higher interest rates, but we've seen from previous auctions that the debt management office has continued to keep rates below 17%. Even though in the secondary market, we're seeing, interest closer to 17, around 16.8, 16.7. But, from the last auction, DMOs continued to sort of like manage its borrowing costs. We expect that to continue at this auction.
Okay, definitely. You mentioned that this borrowing is becoming a regular feature now on the fixed income markets. So is Nigeria now living with debt as a permanent budget tool, not just an occasional fix here, because we keep seeing these borrowings coming in?
Oh, this is actually like a permanent tool of funding the budget deficit. Every now and again, you'll find that the government declares to spend, I think this year's budget is about 52 billion, 52 trillion, if I'm not mistaken. And revenue is budgeted for about 30 trillion. Where would the balance 20-something trillion come from? Obviously, it has to be through borrowings. And so this is a permanent feature in the, in the fiscal nature of the country. We sort of spend more than we earn. And so this borrowing happens every month and will continue to happen until that budget deficit is addressed.
Okay, you talked about investor sentiment, how they're going to be looking at the bonds next week. Are investors confident in our bonds, or that's government bonds, or just chasing higher returns at this point?
There's been no sort of scare on the part of investors where they have any reason to worry about the government's ability to repay its debts, at least locally, and even internationally as well. We haven't seen any sort of scare. Look at the ratings that we have from the likes of Fitch, the likes of S&P, Standard & Poor's. The ratings continue to show that the outlook is stable. The ratings are stable and with outlook stable. So it's credit rating and they are very healthy. So there is no scare for a default either locally or internationally. So investors are, just chasing higher returns largely. There is confidence in the government that they will continue to, pay their debts as and when due.
Okay, so if yields drop, you mentioned that earlier, would we see demand still hold at the same level if they're confident, or just that the government is going to keep paying?
No, you have to look at it against alternatives. Yes, some people have portfolio allocations that must go into these debt instruments, and we would have those. But would the demand be strong enough? Would it be around 600 billion to a trillion? I don't expect that, because there are options. Investors can go to the capital markets. Investors can go to even money market, because the yield curve is inverted at the moment. Even the money market is paying higher returns on the short-dated papers than on the long-dated papers. So there are options for investors rather than going to lock in a 10 or 20-year investment.
You talked about this being a permanent feature in our borrowing, government now using it to fill up the gaps in the budget. But is the government actually raising to pay new money for new spending, or is it just borrowing new money to pay back old loans?
It's a bit of both. Part of it goes into debt servicing, and part of it goes into, new capital investments as well. The breakdown of the budget shows that part of it goes, this is how the monies that are raised are actually spent. Some for debt servicing and some for investing in capital projects. So it's a bit of both.
Okay, so now that we know that bonds are increasingly marked to market, we have to pay attention to that, meaning their value, that moves as interest rate changes. How much are recent changes in interest rates affecting the actual value of bonds, bond holdings on investors' books? You understand, even for those who plan to hold them to maturity?
Yes, currently many of the bonds are at a premium. You take the 2035s, for example. It has a coupon rate of 22.6%, but it has a current yield of about 16.5%. That tells you how expensive, it is. bondholders are paying almost a 22% premium to hold each of these papers or to invest in these papers. That also tells you the confidence that they have, in those papers. So.
Hello, are you there, Caleb? I think we've lost Caleb there. Caleb, can you hear me?
Can you hear me?
Yes, I can hear you. Go ahead.
Oh, fantastic. I was talking about, bondholders and the view towards these instruments. So interest rates regarding the bonds are trading at a premium. That's part of the reasons why the DMO is issuing the 2035s, because, for a bondholder, for an investor to buy, one unit, they'll be paying around, about 22%, premium on those papers. And so those interest rates currently are affecting those bonds actually positively. The bonds are, better valued, so to say, for, legacy holders.
So investors should not be concerned about price losses on paper, even if they hold to maturity. Is that what you're saying?
Absolutely.
Thank you so much, Caleb. But what on the yield curve now? Where are investors playing at the moment? Can you just tell us that very quickly before we?
The short end of the curve. We're seeing more investors in the, like I said, shorter dated instruments. You find them on the 1-year instruments more than in the 10-year or the 5-year or 7-year papers. You find that every time there is an NTB auction, you look at the volume on offer or the volume on the 1-year, volume of subscription on the 1-year paper, sometimes over $1 trillion. Right, and the DMO has just been selling just a portion of that. So investors are largely on the short end of the curve, 1 year and below.
Thank you so much, Caleb Alemi, Chief Dealer, Providence Bank, for sharing your perspective on the show.
You're welcome. Thank you for having me.
Now let's look at other equities in the Gulf. Now we see major equities trading mixed at intraday, with investors closely watching the high-stakes meeting between U.S. President Donald Trump and China's Xi Jinping for any signs of a breakthrough on the Iran war. See, Dubai's index is down 0.36%. Abu Dhabi is marginally down 0.01%. Let's look at Saudi and the Qatari indexes. We see them trading in positive territories, 0.04% for the Saudi index at the Tadawul, and we see Qatar index trading 0.23% up. Let's look at flip now to U.S. and see how they performed ahead of this meeting. Now we see stock futures rose in pre-market trading, with the Dow Jones Industrial Average on track to retake the 50,000 level following strong earnings from Cisco Systems and a key U.S.-China meeting. Now Dow futures gained 0.7%. I see S&P 500 futures adding about 0.3%, and Nasdaq futures that rose about 0.2%. Now Cisco shares jumped 15% in pre-market trading after stronger than expected quarterly results and guidance, alongside plans to cut nearly 4,000 jobs. Boeing also gained more than 1%, supported by expectations that the U.S.-China summit could produce new deals for American companies. Now let's look at Asia markets and see how they closed trading today. It was mixed as investors focused on the Trump-Xi summit for direction on global trade and economic relations. In Japan, we see that down nearly 1%, standing now at 63,654 points. We see South Korea gained 1.75%. That's supported by strong moves in Samsung shares despite ongoing labor tensions. Now in China, we see Hong Kong flat in the green, and mainland China, Shanghai, that declined about 1.5%. We see that very quickly on the screen. And we see India's Nifty 50 up 1.18%. Now, the war in Iran is affecting countries and economies everywhere, and it's hitting lots of different sectors, often with rising prices, creating problems for companies and consumers. Now, in Germany, the latest sector complaining now is road construction. Lars is joining me from there, from Deutsche Welle, and he's going to be telling me what's going on. Lars, what's going on in Berlin?
There's not much in any country's economy that looks quite as local or regional than road construction. After all, it's happening right where people live, where they drive. But of course, certain materials are needed to build roads, and those materials are hugely affected by price swings due to geopolitical problems. And looking at road construction, those crews paving new streets, they're using asphalt. And asphalt needs a bitumen as a binding agent. Bitumen is an oil derivative, And with a higher price for oil, that of course being directly due to the war in Iran, the price for bitumen is up too. A ton of that particular material cost around 350 euros before the war started. The cost has since doubled to 700 euros per ton. And since the bitumen business, or the asphalt business, is a low margin business, companies are now complaining that they just can't eat the cost. They can't currently make and sell asphalt at a profit. And what makes their situation more complicated, their contracts are usually done way in advance with fixed prices. So they do not have an easy way to raise prices in an effort to reflect their rising cost.
What is happening on German roads then?
Not much if things aren't improving for the sector. That's what we're hearing from companies that are afraid they can't continue making asphalt, and they're clearly saying that road crews will run out of materials soon and that road construction and even road repair could come to a stop. Now, besides the obvious problem of an entire sector being sidelined, this would be much harder for Berlin to stomach. First of all, for years, Germany failed to invest appropriately into its infrastructure, and currently there's an incredible number of construction going on everywhere. Streets being fixed, roads being built, but also bridges and tunnels getting repaired. The government has massively upped its investment in infrastructure out of necessity. But this investment was also meant as a rescue package for a faltering economy. 500 billion euros were supposed to be spent on infrastructure, but if companies can't do the work, these investments won't happen. Companies would actually be worse off than before.
But so what can Berlin do to fix the problem, since they can't control oil or bitumen prices?
Indeed, they can't influence the price, of course, so they will have to find a way to support asphalt makers and allow them to retroactively raise prices for their work. That's obviously not a popular idea in the capital, but to be quite honest, it's not unthinkable considering that the government has also just lowered its gas tax in an effort to help drivers with the cost of a tank of gas or diesel. The chairman of the Association of the Construction Industry just said this week that companies in his sector are feeling left alone by Berlin, and he's warning of long-term problems if there isn't any help coming soon. Those problems, of course, could be twofold. On the one hand, the country could just lose some companies if they go belly up due to their margins evaporating. And on the other hand, companies might have to calculate higher prices in future to make up for the risk that they're taking. That would make construction more expensive in future, and it would again hit the government, because specifically in road construction where asphalt and thus bitumen is needed, the government is really the only big customer.
Definitely the pass-through from the Iran war, we're still feeling it, and we're still looking forward to, well, not looking forward to seeing its impact in many places. Thank you so much, Lars Alter, right there in Berlin. And so we'll move on to crypto and see what's happening there today. Is it going to be bullish or red, or see what the market says was bullish. I mean, it's red today, again losing the $80,000 mark we saw yesterday, 0.47% down. Ethereum is also down today, 0.83%. XRP is in the green, up 1.34% to $1.44. So CTRX also in the green. BNB is in the green. We see today Solana is in the red. However, I see a lot of people taking profit from Bitcoin and alternate coins there. So let's just see what's happening, what's making headlines there, what's driving sentiment. The Republican-led Senate Banking Committee on Thursday is set to consider long-awaited legislation that would create regulations for cryptocurrencies, and that's a landmark step for the bill, which has been bogged down by a dispute between cryptocurrencies, crypto companies and banks. And Clarity Act would clarify regulators' jurisdiction over the sector. Thursday's markup, when senators debate, amend, and vote on whether to advance the bill, will indicate if it can win the at least 7 Democratic votes needed to pass the full Senate. Next up, we see major crypto exchange Binance has announced a move to delist 20 cryptocurrencies from its Alpha platform, and the removal will be taking place today, May the 14th, and the tokens affected include Priya, Common, Ping Pong, Taker, and Janitor. And finally, blockchain.com today announced the global launch of crypto-backed loans, a new lending product that allows crypto holders to borrow against their digital assets without selling them. The launch marks a significant expansion of blockchain.com's consumer and wealth offering and positions the company as one of the first globally regulated crypto platforms to bring crypto-backed lending to clients at scale. And through its established international footprint, blockchain.com is launching this product as crypto-backed lending surpasses more than $70 billion. And that's it from the crypto space, and that's a wrap on Business Incorporated. I am Will Ibong, and I'll see you same time tomorrow this day. Bye for now.